Good afternoon. Welcome to Chicago Future of Finance. I'm Oliver Renick. We're down here on Cboe floor and market's off, but we're also up off the lows too. So it's actually not a terrible day right now. We're at VIX 17.3, high was 19.7. Big sell-off in Microsoft, that's the main story. But there's an even bigger sell-off happening in crypto compared to stocks. We've got gold holding just solid again. Really extraordinary that gold just doesn't miss a beat, really. Getting harder and harder for Bitcoiners to justify their existence. Trying not to put it too harshly, I think I've been very fair in the price analysis of Bitcoin, and actually on my risk radar, it still is yellow. Bitcoin yellow right now until we break down further. And for me, the line is basically at 80,000. But here's the bigger deal for crypto is that right now investors are selling Microsoft on the notion of it being lower quality tech than perhaps they had priced, given how much the company is spending on CapEx, about $120 billion a year, something like that. But here's the problem with crypto is that there's still about $3 trillion in an asset class that's about as low quality tech as you can get. Blockchain might have some good utility for storing information, locating it and distributing it. But in terms of money, we know crypto does not work well. And in terms of portfolio diversification or utility, crypto is getting worse. Now, if you had paired it with something like gold, you'd be okay over the past year. But if you were using this for anything other than just pure speculative element, then you're obviously losing, because Bitcoin now is going down more when stocks are down after a year in which it didn't go up when stocks were up. That being said, on the chart, here's what I think matters the most. BTC still holding low 80s. That means it's a yellow light for me until we break that support at 80,000 that has establishment from the spring as well as the end of last year with some gappy nature on the chart. Now, the bigger problem, obviously, for crypto is that if you start to venture too far down below 80,000, then you start to run into you know what and you know who. Mr. Michael Saylor's strategy, who right now has a Bitcoin break even, according to Gemini, of about 74,400. So we are getting dangerously close. And basically for every moment that Bitcoin trades below the value at purchase of a company that spent all their time, money, and energy buying this asset, then they're essentially on their way to bankruptcy logic. That's my simple logic. When and how, that's for the mathematicians to figure out. But it becomes a very serious problem if Bitcoin breaks down further through this range to the downside. So let's talk about something positive here for a second. The S&P 500 futures actually are only down right now 60 basis points. And on the weekly chart, things look perfectly fine and good. You're sitting with the S&P right above 70, a big whole number that could have presented a much tougher challenge than the one that it is right now. We've been kind of hovering and floating into the high 6,000s. And just earlier this week, of course, we were putting in records. Yesterday on the index, the futures, as you can see here, also the same. The candle today with this long wick is a nice registration of buyers holding things together. But of course, when it just comes to overall trajectory, gold did fade from the highs of the day, but it still put in a new high. Gold just incredible, and that's why also it's had the longest running green light on my risk radar, because of the chart and because of the logic and because of the portfolio tools that we're seeing that it provides. Then lastly, I would say that in terms of the macro, tomorrow we've got inflation, but bonds are pretty calm right now, 17 basis points. We continue to have a little bit of a battle around 4.2%, which I think makes sense. I don't see us going below that anytime soon. Dollar also taking a little bit of a break from the epic beatdown it took earlier in the week, but that's still red on my risk radar because of the trend there too, and the fact that it looks very much like President Trump is, if we didn't already know, extremely fed up with Jerome Powell. Not that he should be, but he is. By the way, speaking of why not to be too upset, look at today's numbers that came out for factory orders. Above expectations. That's pretty solid. The other economic data that we had were also pretty solid too. Productivity and costs, same as last read. The AI world, I think, is making it a more productive one. And jobless claims, very solid there as well. So I just don't think that cutting rates is necessary right now, and that probably means yields will stay elevated, I think, and the dollar weak. That being said, let's talk some volatility. Let's bring in the pros. Mr. Noel Smith joining me from Convex Asset Management. Noel, VIX kind of holding in for the ride in stocks too. We tried to buy the dip pretty good earlier.
Yeah, I mean, it's really, everything's been exactly as we talked last time, which is to say, market did go down a bunch today, vol did pop, but it's nothing all that urgent. I still think this is a risk-on scenario. I'm not worried about the marketplace.
Okay. Risk on, do we have to be specific in terms of where we deploy it? Because I feel like we are getting some kind of, separation of wheat from chaff in terms of the risk spectrum. Like we look at Microsoft and all of a sudden market goes, oh, that's not a mag that we want, but Apple could be a totally different story.
Yeah, I just tweeted out and I tagged you on something that I thought was kind of relevant to today's conversation, which is a dispersion trade. So if you look at Meta versus Microsoft, and if you look at how much those two things are diverging today, and I'll pull up the real-time prices here. You got Meta up 10%, and you got Microsoft down 12%. But if you look at the equal weight index, it's unchanged. So you've got something going this way, something going that way, but the index is dead flat. And that is, in real-time visuals, the essence of a dispersion trade. So there's opportunity there 3 times. You can be long vol in Microsoft, you can be long vol in Meta, and you can be short vol in the index, and you can make money 3 times. And people have asked me several times, like, what does this really mean? Well, right now, today is a real example of where that's working out exactly as intended.
The VIX, too, seems like it doesn't want to venture below 16 too far either. Technical analysis working pretty good here to just kind of continue the uptrend in VIX. Okay, so break that down again for me, Noel, because dispersion really is your cup of tea. And I love that, to your point, sometimes we get math showing up very easy for us, and today it kind of does with the S&P only down 50 bips. Because to your point, you've got Meta on the other side of Microsoft. By the way, there are a few other laggards like Las Vegas Sands, which got blasted, and Wynn Macau looking pretty slow. But then look at Southwest up big at the same time that you've got LVS down. So you're in that, even within that sector, of discretionary. So, in travel, Royal Caribbean up. There's stuff going everywhere, and the net is basically somewhat unch.
Exactly. So which is to say, who cares what all these names are doing in aggregate, right? They're all doing their own thing. They all have their single narrative or their story as to why they're moving. And the big ones, of course, are the ones that matter the most because they have the most apportionment within the index. But if you look at the index, down 50 bips, and if you look at the equal weight index, it's dead flat. So if you're short volatility within the equal weight or even the index, that trade is going great in the sense that you're making money on your short vol, depending on where you put it on. And then if you're long volatility in the constituents of that same index and they're going crazy, well, you have an opportunity to make money on both the long vol side, which is the names, and the short vol side, which is the index.
Yeah. So there's like a mirror image. Maybe we call it the mirror image market to help people out. There's a mirror image. For Microsoft, there's Meta. For Las Vegas Sands, there's Royal Caribbean. For United Rentals, there's, Industrial Southwest. That's kind of a fun way to trade this market because to your point, if you pair stock positions with index positions, you really start to derive some of the value of that volatility dispersion. Something we've talked about really, I think, all week coming into this as well. Hedge. Like, for example, you walked through one that was kind of 3 parts, Meta, Microsoft, and the index. But depending on where you are, you could use, cheap index vol to hedge your stock vol, right? Stuff like that.
Yeah, we do that all the time. And also in terms of vol, if you look at the options within SLV and GLD, which is silver and gold, the vol is on the moon. So if you have an appetite or the bandwidth to sell some volatility, I think now is an excellent time. And not only that, but the spreads are so wide. If you're patient and clever or you have good algorithms, there is great opportunity in those names right now. So if you're a spread trader, condor trader, there's just a lot to do. There's a lot of opportunity in the marketplace.
Yeah, true. Okay, so explain to me the chart. We're going to look at this in a different format real quick, but that I think is cool. And MDAB, MBAD. Tell me what we're looking at here, because I know, Noel, this is a visual of what you just described. And it looks like we've got somewhat of a skewed distribution here.
So if you look at that table, that chart, what you'll see is on the extreme left, Microsoft, and on the extreme right, you have Meta.
Okay,
right?
so this is today, this morning.
This is right now. Well, this is 10 minutes ago. Okay. So if you look at the left, it's going this way. You look at the right, it's going that way. And in the middle of the index, you've got a whole lot of nothing. And that's exactly illustrating the point, which is a dispersion trade or having a unique market neutral, in other words, it's a delta neutral type of a trade that you can put on, is a really unique way to extract alpha out of the marketplace.
Yeah. Okay. So now that where do we go with this tomorrow? Because tomorrow we've got, I don't know if PPI is going to be a real blockbuster, but it just does seem, as Brent was telling us the last couple of days, he was looking for spasms in the market. I feel like this is a spasm, right? It feels like, it's a jolt, but we kind of go nowhere, right? The spasm, you kind of end up where you started to some extent.
Yeah, I mean, we still have a risk on posture. This is another part of our book that we have on that's working. And against that, we also carry a hedge, which is to say, we have some long VIX options so that if the market does crash, we're prepared for that. And we also, we budget for that appropriately. So it's not a large part of the book, but because there is so much convexity to it.
Yeah. All right, so the mirror image market, but to your point, because the market cap skews obviously to heavy towards big tech, if those ones start to drag their feet a little bit more, for every big tech loser, it requires a higher number of non-tech winners. So we really do, if you are net positioned long in this market, you do want Apple to kind of come to the saving graces tonight.
Well, whenever everything goes to one side of the boat or the other, that's a high correlation event, right?
Yeah.
So if everything is going one way or everything is going the other way, you're gonna, a dispersion book would lose money because that's the point of it. A dispersion book makes money when everything has its own separate plan, but a dispersion book loses money when everything moves as a unit. And so if all tech stocks or all stocks go down tomorrow or the next day, that's going to be a problem for those types of books. Additionally, if you look at oil has been rallying quite a bit. And if you think of oil as being an input into inflation or future inflation, that could also be a little bit more derogatory for market prices.
Good eyes on oil, one that I oftentimes forget. I noticed that earlier and I forgot to put it in my open, so I'm glad you reminded me. Thank you very much, Noel. $65.50 right now. Pretty key line, it seems like, on the chart. I didn't have it already, but I'm going to drop it in here for CL futures because it looks like that was a point several times where there was either support or there was a hard fight one way or another with crude. Is this just every commodity rallying with the dollar under extreme attack, basically, by the king of the dollar himself, Mr. President Donald Trump?
Well, is it the numerator or is it the denominator or is it a blend of the two? Is it that everything is going up or the value of the things that you're pricing that stuff in is going down?
Well, certainly the denominator with the dollar has gone down. I would say for gold in particular, there's a numerator factor as well too, which is that it has really good use in the portfolio. It has some secular, or rather kind of sector-specific use. I was kind of railing against Bitcoin at the top of the show because it's just been a bad diversifier. It basically has only diversified negative now for 14 months, something like that. Since the tariffs,
it's not just those things, though. It's also houses. It's also the price of shoes. It's the price of an education. It's the price of healthcare. The price of everything. So at some point, it might be more accurate to say it's not that everything is going up in unison. It's more that the value of the things that those things are being priced in is going down.
Yeah. Do you have a favorite in the commodity space, Noel? I know you stabbed a few times short silver as kind of a speculative hedge to the overall kind of market buoyancy. Last we checked, I think maybe you were on your way out. You kind of said you're going to expect that to expire at zero, basically.
Well, I have some March puts and I'm still long them.
Okay,
they've gone down in value. Yeah, I mean, the trade is still around. There's no point in me covering now. Again, they're long puts. I didn't pay that much money for them, and they're worth less now. So it's not like I'm going to cover them for a small amount of money. But the idea that silver and gold have some kind of retracement, and I can capitalize on that with options, that is kind of what I like to do.
Yeah, okay. Anything else that's hot on your book going into tomorrow or next week? It sounds like basically the dispersion trade. This is kind of your bread and butter market.
It's working. It's working as it's intended.
How do you decide which side to lean into it? Index, is it just right now that the index vol is still pretty cheap compared to stock vol? Is that the core still of kind of the way you pick a side on that trade?
That's not a 10-second soundbite. That's a larger conversation.
Well, hit me. We got a minute. Yeah.
The idea that you can go long dispersion, the problem with that is somebody has to sell that dispersion to you for a price that they think is economic. So you have to time that really well in order to make that right. So if you're going to buy an S&P 500 straddle, if you could buy it and carry it for flat, which is to say cover your theta every day, that's a great trade. I would love to just buy S&P straddles and then just hold them for nothing and then have them blow up every now and then I make a bunch of money. Dispersion has a similar concept behind it, which is to say nobody's going to sell you that trade for a price that isn't good for them. So you have to be able to out-clever them or out-time them or out-luck them in order to put that on. So if you want to go long that trade, which is to say the opposite, long index and short single names, it's harder to time accurately.
Okay, I like that point. For those that kind of maybe don't think about dispersion or hear the word as much, the easiest way to think about it is just the inverse of correlations. So when we look at this core 1M we've been tracking, today's big candle, correlations went up and then came back in. So if you had so-called bought the dispersion on the dip, so as correlation went up, dispersion went down, you basically bought the dip on dispersion, that would have been today's trade, right?
Correct, that's right. Again, that trade, one is just as easy to put on as the other side if you're doing it programmatically. It's just a matter of timing it.
The other thing, too, I think, is that a lot of people are getting more comfortable trading volatility as an asset class, vol, and dispersion versus correlation are just two different types of vol. Well, they're the same, but one is just, we describe it differently, look at it come from kind of the other side of the mirror. But, they're just different ways to look at volatility so you can get specific in what type of volatility you expect. Right, that's kind of what this is about. You don't have to, take one directional view. Basically, you can get very specific, kind of carve out your own niche of volatility. So, do we just assume then to buy, dispersion dips per se, Noel?
That's harder to do than you think. Think about it like, do you want to sell insurance, car insurance, in the USA? Well, the weather in Maine is different than Miami, then different than Seattle, then different than LA. There's a lot of moving parts in there. And if a hurricane comes in off the West Coast, but a snowstorm comes in off the East Coast, there's a lot of moving parts. So if you can isolate where the risk pockets are, but overall car insurance, there might not be in aggregate any more car crashes in January than there are in June. But that's what you get paid for.
Yeah. By the way, are you still liking variance futures for this? Because again, to throw in another, term here, variance, another type of a definition within volatility. And so I would imagine that, when you're trading dispersion, variance is a very clear way to do it, right? Because it's basically the opposite. It's more like correlation.
Exactly. So variance is just the square of volatility. And what it ends up happening is volatility might have more of a linear kind of reaction or linear ball path, and variance is going to have more of a convex type of a movement to it. So there can be a really good use case for being in variance futures specifically as a hedge because they have so much convexity to them.
Yeah. Oh, hey, here he is. Look at this. Handsome guy down here at Cboe. That looks like you. I just pulled up the Cboe page on variance futures. There's actually a part that I was looking for here. To kind of dive into this again, right? So we talked about this before. Are you finding that the liquidity is getting deeper here, Noel? Do you find that you're, how big are you swimming in this pool? Because I know you were early to start trading these.
Yeah, it's still pretty illiquid, but I still think it's a cool product. The market makers do a good job in terms of not making the market so wide so as to make it prohibitive. But I think as more people put their eyeballs on it, especially if you're long it, right? If you're long it, the most you can lose is what you spent. So the idea that you can put variance futures in your book as a hedge and just kind of let them sit there and they will do their thing if the market starts to move around more, then that is a really good way to use these things. You can short them too, but that's a different use case. But there is no reason that people shouldn't understand the product and maybe take a stab at it once they get familiar.
Yeah. All right. Well, I also like good stuff bringing us today, Noel. I also like the notion of seeing the dispersion along the distribution as well that you gave us. I think that one's good too. So we'll close kind of looking at that for a moment here because tonight, obviously, we still have plenty of big tech companies. The next 24 hours could be interesting. If it does get nasty, Noel, then we would just expect this curve to get pushed towards the left, right?
Well, toward the Microsoft side, which is red.
Toward the Microsoft
so if everything's
side.
If things get nasty, yeah. But that won't really shift the curve. What it'll do is it'll move the names within the distribution to the left.
Right, which would be big ones.
Yes, it would.
Okay. Yeah. All right. Well, we hope that it doesn't go down like that. We hope that market can find some support from Apple, or else it could get pretty dicey. But we're hanging in there right now, a decent amount. Noel Smith, great stuff. Thank you very much, sir.
Thanks, man. Bye.
You got it. Nice perspective, especially thinking about dispersion versus correlation and volatility, different ways to define volatility on a day like today. Someone who we talked to about potential volatility this year is Steve Sosnick at Interactive Brokers, when we talked about his outlook for the year ahead. I'm going to get him right in the conversation here, joining us, Chief Strategist at Interactive Brokers. Steve, good to have you back.
Great to be back, Oliver.
Brent Kochuba here on the show yesterday was talking about how the volatility market kind of looked like it needed some spasms. I know you and I, and this is definitely a spasm, I think, but you and I talked at the beginning of the year that you thought this was just generally going to be a tougher road to hoe in 2026. So how does this fit into your thesis?
This fits in to some extent. I mean, I think you get, where you have people moving very quickly, and I know Noel used the phrase moving to one side of the boat to the other, and people are doing that in big ways here. You could see it, in the way they're reacting both to Microsoft and Meta today. There's not a lot of nuance in the way they're responding to corporate earnings. There's not a lot of nuance in the way that there's chasing of rallies or selling of losers. And so, if they grind against each other, as you were just talking about dispersion versus correlation, if they grind against each other, well, then you end up with stasis. I look, by the way, at correlation not as a form of volatility, as a factor of volatility. Index volatility is largely determined by correlations. If you have everything moving if you have everything grinding against each other, you have no volatility. If you have everything moving in the same direction, even by small amounts, you get a lot of volatility. Right? I mean, you could have, if you take a mythical 2-stock index, stock A goes up 10%, stock B goes down 10%.
You're running in circles.
You get nothing. So
you're going nowhere fast, as they say.
I see it as an input rather than a form of. But again, that's quibbling. But basically,
I think to your point, Steve, though, that's important, though, is because sometimes, one way to describe this is kind of cracks forming. Which is why I've generally been very positive on stocks. We talked about some of the risks that we agreed on, namely potential for yields to cause issues if we're going to just start cutting rates from replacing the Fed for kind of no reason. We'll come back to that. But otherwise, my point has just been, you watch tech, you watch semis, you watch the core AI trade until it breaks down, then you don't have to be worried. This could be, this is not a breakdown, I would say, because we're only down 50 bips. But a big move in Microsoft like that, the market can only take so many body blows before dispersion was the predecessor to bad correlation.
Agreed. I mean, you can only knock $400 billion off of a company so many times. Right? I mean, I heard someone say today that Microsoft's lost a Bank of America. Put that in perspective in terms of the amount of money. So we lose sight of the amount of money. We also, I don't know exactly how much Microsoft has gained, but they've probably gained, pick a large company there, Caterpillar or something like that. These numbers are enormous. And so, today, imagine, we would have had a much bigger move in either direction had Microsoft and Meta been on the same side of the trade rather than the opposite. But I see it also in so many other situations. We've gotten, we went parabolic in silver some time ago. We've since gone parabolic in gold in recent days. But, if you look at the type of volatility we're having there, and you mentioned Bitcoin earlier being, sort of an awful hedge these days. I do think that there's a substitution effect. I think people have moved out of Bitcoin and into precious metals because, quite frankly, it's not that hard to do anymore. You used to have to really be devoted to crypto to buy it. Now you can just buy IBIT or something similar and then sell that out and buy GLD or something similar. So that, I think, is a bit of a substitution effect. But when you look
that's based on performance, right? That's based on real, it's not guesswork, which I think is really important. A couple of years ago, fairly recently, gold's been on this multi-year. If you've been watching gold closely, you've been seeing that it has been proving its worth very well basically since COVID throughout a lot of different macro regimes, but it wasn't really like straight in your face obvious, I don't think, for many until this year. For Bitcoin being a nascent asset, they've always been able to kind of say like, well, we're going to, one day it's going to take these properties on. Sure, maybe anything could happen. But the more that the time adds up, when you get different regimes like we have had in the last 2 years, and then the market keeps going this way, it starts to, get hard to say, oh, well, one day, like, well, let's see it, baby. Price is king. Show me the money.
It's hitting here. Crypto it was really an asset for, younger people who are willing to really take the plunge. Last year, with the advent of ETFs, it became something anybody could buy. My term for that is crypto became for normies.
Yeah.
Anybody could do it, and you had people who were more performance chasers. But if you're looking at the volatility now that we're gold and silver, that's getting watering. And one of the things, people always ask me, get into a parabolic type of moves, which are inherently unstable. And silver has been in a parabolic move for several weeks now. Gold is more recent of a parabolic asset, but they're inherently unstable, and the volatility has now increased dramatically. 8-10% moves intraday. Let me remind everybody that volatility tends to increase at turning points. So while I'm not saying that I know when the music will stop, because that's pragmatically impossible on parabolic moves, you do have to wonder whether the band is getting ready to take a breather when you see this kind of volatility.
Yeah, fair enough. A predecessor to it. Okay, so on the macro side, by the way, Steve, the last thing before we go macro and talk bonds, just one more thought on Microsoft and the earnings as well, which is, I look at them though, and I still see very reasonable PEG ratios. I see very reasonable valuations, especially if you compare it to other boom times of technological advancement. When you normalize by growth, they don't scare me. Do you think that they should? Is there a real issue with how much these companies are spending?
Well, that's really you've hit the crux of it. They're actually in many ways not that expensive considering how fast they're growing. The problem is they're spending so much money. You do have to wonder, is that money going to be well spent, and how much of a drag is it going to be on earnings? One of the beautiful things about these companies for the last few years has been that they've managed to be asset light and money-making machines at the same time. There are money-making machines out there, whether they're drug companies, industrial companies that make a lot of money, but they have giant fixed costs and fixed assets. These companies didn't have that. Now, when you hear about Meta saying, oh no, we're not going to spend $100 billion in 26, we're going to spend somewhere between 110 and 135 billion dollars.
A market like theirs, though. So it is making choices.
They're like the fact that sales are growing. So they figured that they'll get away with it. Microsoft, they're not Azure kind of disappointed. At the same time, they're spending more.
Yes. Well, that's a key point. I think that's a very key point too. Is that the cloud stuff has not been a great AI beneficiary. Of course, it's been a disrupted group by many respects. So I could see where Microsoft kind of overlaps. I mean, obviously, it's a big part of IGV, for example, where they've had to be responsive to AI. There's a lot of things in the Microsoft Office suite now that I can get from AI, and it is amazing. I mean, I literally just did a PowerPoint the other day, and it was like, awesome. I would have had so much more time to goof around in college. That's all right. I found enough anyway. Steve, tell me about bonds here before I let you go. I got Phil Streible on deck, who's itching to talk some futures with me, I know, but we got the 10-year yield right at 4.2. There's an announcement coming from the Oval Office apparently here any moment. Might be related to the Fed. Strong words out from the president. He just freaking hates Powell, and he's not afraid to say it. So, I mean, it just seems to me dangerous world in the bond market.
That's kind of it. I mean, I think the worry that the bond market has is twofold. Number one is that there is, I don't want to call it a sell America trade, but I would call it a looking elsewhere type of trade. And especially when you look elsewhere and see Japanese yields, having soared, although they've recovered a bit, and seeing pressures elsewhere, and seeing and talking about when we see crude oil up 4% today, and we're talking about non-precious metals zooming, those are inflationary pressures, as is a weaker dollar on the consumer in a country where we're net importers of goods, of a lot of goods. So there is nervousness out there, and I would like to see bonds recoup the 420 level significantly. The longer we remain above it, the more risk we have that we head back toward the 430s and even 440s. And that is a concern. Powell talked a game about inflation, saying that it's relatively under control, saying the tariffs are getting in the right. We'll sort of, he didn't use the word transitory, but he implied it. But there's other inflationary pressures out there, and if you get a much more dovish Fed, I think you're going to get a much more scared long end of the curve.
There you go. You get it. I think more people have, nowadays, but that's what I liked about your analysis for the year, and we talked about because of that relationship between dovish Fed and higher long rates. And it looks like that's what's playing out, A lot of people got fooled by that round one. A lot of people got fooled by that when yields went up after they started cutting. And, I don't know how much they're going to cut, but yesterday we were looking at the odds on some of the betting markets, and they're saying there's like a 25% chance of a cut more than 25 bips. So, it's getting to the point where if there's enough political pressure, honestly, who knows what's possible. And that's why I think that fixing something with the Fed when it's not broken really is just a tough trade. I'll give you the last thought, Steve.
Powell said something that resonated with me, and he said we're on the high side of neutral, but if you look at markets, what out there tells you that we're at all restrictive, and that's really it. We're still seeing money flowing in a lot of places. I think there's going to be a tug of war. Whoever the new chair is, Powell laid out the point that most of the committee is not in favor of rate cuts, barring a big change in data. We're going to really see how that plays out. That's going to be a very, shall we say, interesting soap opera over the next few months.
Nice use there of that phrase, because I just pulled up Trump on Powell, latest Google results. Straight up called him a moron. I mean, wild stuff. I guess all you can do is, it's entertaining to your point, I guess. I don't know. And from the market's perspective, I'm all for entertainment. It still starts messing with my market, baby. But maybe we'll have to learn that the hard way. I'm not sure that the bull market wants madness and political intrigue and soap opera drama at the Fed. But I don't know. We're pretty close to all-time highs still, so it hasn't broken down just quite yet. Steve, always great to get your thoughts. Appreciate the input. Great to have you on.
Thanks so much, Oliver. I hope we talk again soon.
You got it, sir. Steve Sosnick, Chief Strategist at Interactive Brokers. All right, we got a 2-minute innovator buffer break, and then we're coming back with Mr. Phil Streible, going to run through some of the futures action, as, of course, gold did have a winning day earlier, then it reversed, then it came back. So we're kind of like break even for gold now, heading into the last 27 minutes of trading. BRB.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. We got S&P 500 kind of meandering here, but still down on the day, roughly about 50 bips. Not a whole lot has changed since we started the show. 69.41 is the ticker right now. I got Mr. Phil Streible joining me from Blue Line Futures, Chief Market Strategist. Phil, great to have you on. Good to see you again. What's up, man?
Yeah, thanks for having me. A lot of volatility in the market. It's been neck breaking here, and it's amazing just the ranges that we're seeing across the board. Precious metals, we're getting some geopolitical risks going on. We got crude oil prices pushing up. Seems like a 1-2 punch in a lot of different markets. Cryptocurrency's under a lot of pressure in U.S. equities, but some of these markets are coming back, but it looks like the crypto's left in the dust right now.
It is, yeah. S&P is kind of fighting to get higher to 69.50, but you know, Bitcoin is at the lows of the day, so just again underperformance. When does the crypto as a portfolio diversifier pitch start to take on water, Phil? I mean, I kind of think it already has, but of course, I'm kind of expecting
I really think so. I think so as well. And, you know, if you look at the top, when MSTR, that was the leverage play on the cryptocurrencies. And once they launched the options contract on Bitcoin, that marked the top in MSTR. So you see this market here, and there's just not a lot. I mean, people are going for the hard assets. I mean, as seen in the precious metals and things like that, maybe crypto has moved on, is going to sail off into the sunset. Who knows? But you know, we'll have to see. You look at the correlation between the dollar and Bitcoin, they're positively correlated. So as the dollar continues to sell off, Bitcoin is selling off with it. So that's something to note as well. Well, the gold market has a pretty strong inverse correlation.
Very good point. It just kind of seems like Bitcoin's getting dragged in almost all macro environments the last 12 months. And by the way, I know that people say, hey, well, we just put in a high in October. I get that, but for anyone who's watching the show and following me, I've been pounding the table on the bearish divergence that's been going on for years. So even though we did put in new highs, it was on lower and lower momentum, and the breakouts were smaller and smaller. So my point was that's kind of how it looks like, something that you sell the next guy, that's how it would peak out to me, because you just eventually, you get to a new price, but it's increasingly difficult. That being said, Phil, we're still in the 80s, so how do you trade it? I mean, should we try and buy this dip here in crypto and trade this range and just be quick about it, or what?
I don't think so. I think that people are getting a bit of a wake-up call, and the reality is setting in that this product is not keeping up with many other things. They refer to it as digital gold, but they couldn't be more the opposite. And you look at Bitcoin the last few days getting over 90,000. It seems like traders are lightening up on any kind of rally in Bitcoin and trying to rotate in other asset classes, whether it's copper, gold, silver, even the Russell 2000. I think all of these have much more prospects at the moment than Bitcoin does.
Okay. All right. So BTC, hesitant to buy dips. I do think that just from the chart, there could be some nibbling. And if it doesn't, boy, it could get nasty. I mean, what happens if it breaks 80K and goes below Masters break even?
That would be
it's like
significantly problematic. I would have to, then you're going to see that grab headlines where it's like those guys are on margin call. Those guys are having problems. Their investors are filing lawsuits. Things like that. The product doesn't seem as what it seems. So, we'll keep an eye on like Tom Lee and that BMNR and other crypto plays out there.
Yeah. All right. Let's talk about the stuff that seems to be strong. Silver up another $1.10 today. And you, I think, pinned the tail right on the donkey last time we talked, because you said it'll probably hit triple digits the next day. And I believe that was the day it did, right? That was last Friday, I think.
Yeah, it did. And then if you look at the way that it broke out to the upside, it went from like really the $50 breakout on up to 82. That was a $32 range, consolidated in the 80s, then finally formed this pennant and broke out, went up another about $32 from there. So it's like that 114 to 120 mark, and that's where we got to. A little bit overextended in the overnight session. Something that we've seen is that there's a lot of story, a lot of hype out there. Hong Kong residents, they are leery to buy gold. It's gone too far, too fast, too high. They're buying silver as the alternative. People were even buying copper bars, which, good Lord, I couldn't imagine that one, because a pound of copper is only worth $6. It just doesn't seem it's worth storing around there. But a big move in copper. That was kind of the rising star today, up 6%. So playing catch up to the other metals. That has been the slow and steady metal, but it really gathered some steam. Something that we've been monitoring is those ETF flows, and the ETFs, they've increased gold holdings for 6 straight days while they continue to cut silver. And silver has not turned positive as far as ETF flows this year. Since peaking last December, they've been just cutting it. It tells you that perhaps with the silver market. So silver volatility has gotten too great for people in their portfolio, so they're trimming their ETF holdings just to beta adjust size the position.
Okay. The ETF flows are kind of interesting, right? Because they don't have to correlate with price, but if there's a big price movement and flows haven't responded, you do kind of get a little bit of a taste of sentiment, there to where there might have to be a little catch up from sentiment.
We were watching like last year when there would be big dips and there was like a huge sell off in the silver market, and then you'd see a massive 8 million ounce inflow into it. Well, the dip buyers were actively present. Now I think that people are scared of this volatility and they're lightening up. So you can get this perception when you are analyzing that market as closely as we are, you get a finger of the pulse of what's going on in there.
Yeah. Okay. So silver, it sounds like in your view is you still want to be buying dips in this. If there's going to be flows that kind of got to catch up. How do you see it?
From a futures standpoint, it's going to be more challenging. The exchange is going to launch a 100-ounce contract, and I think that will bring in participants back into that market from that standpoint, because the reality is unless you count that wave up, it would be much more challenging having an account that's, say, smaller than 50,000, because that's the margin requirement on a 5,000-ounce contract.
Yeah, okay. Also, it seems like there's kind of a chart beginning to develop a little bit technically with some resistance, but we pushed through it. Even today, just earlier in the day, fresh highs. So I don't think it's a bad looking chart. Maybe there needs to kind of have another consolidation period, because to your point, it has taken those moments of sideways movement, whether it was from Jan into the end of that month, if it was late December, kind of through the beginning of the year, but all those were just periods before it then broke out further.
Yeah, if you get a consolidation, then you're going to see, because I've been dealing on the physical side of things, you'll see some of these different wholesalers, buyers, coin shops, they'll start taking inventory back in because they're comfortable with the price action. Right now, a lot of them are hesitant to buy anything on the physical side because of the fact that you're seeing an average true range of $7-8 a day. Today we've got almost 2x that. So, so it's we need a little bit of stability in this market is what I'm saying.
Okay. All right. So we need some stability. Maybe it'll slow its roll a little bit. Seems like all the options flows are still pretty bulled up on it. Gold, it seems like similar in terms of the intraday volatility, Phil, but also just significantly less downside chop as well. It feels like it still is pretty pure. But eventually, doesn't this have to? What if yields finally rip? Right now, gold didn't care about the 10-year going above 4.2. But what if it really takes off? What if we do get, a guy who's just going to slash rates and turn this economy hot?
You'll see more steepening of the yield curve, and the 10-year yield is pushing on up here. And I think that's a lot of foreign buyers here really just questioning buying long-term treasuries in the U.S. with the fiscal problems, the rising debt, and things like that. If you look at the short end of the curve, which is much more what the Fed is able to impact, that's starting to drop. So you get the steepening of the yield curve. I think that you look at central banks and stuff. We've got the problems that went on with Venezuela. We've had Russia. We have it seems like some renewed geopolitical tensions with Iran. It makes sense for people to continue to stack into the gold market for that safe haven play. Central banks also are not as price sensitive to the movements in the market. So they're just going to buy systematically and almost dollar cost average. So I don't think that they're impacted by these higher price levels.
Okay. And also, yields have been pretty calm here since moving through. We had a couple nice fat candles as the 10-year broke through 4.2 to the upside, but it has calmed somewhat. Even the dollar, after getting obliterated, is doing kind of one of these little triangle patterns where the last 2 days of trading have been within the big candle from the breakdown below 97 bucks. So give me the best kind of thing to set up for next week, Phil. Take me through what looks most interesting to you then here.
Well, I'd like to see any kind of weakness in the precious metals market where new participants can come in. I think copper is still one of your best bets, one of the most reliable ones right now. If we can get some kind of dip below $6 next week, that would be fantastic, in my opinion, provide some value. I do like the Russell to the upside. If you look at those companies have reported an aggregate growth, 200 of the Russell 2000 companies of 23.2%. So, and we're seeing this broadening here in those markets. So copper and the Russell are the ones that I banged the table on. I like the gold market, but again, you got to position size properly. They got 1 10-ounce, 100-ounce, 50-ounce, 33-ounce contracts on the future side. So you have a lot of flexibility there. Silver, you got to wait for that smaller contract to be in place. So we want to watch the dollar index, watch earnings, watch everything else, and know that it's not just one thing that moves these markets, it's everything.
Dollar fitting right into the no metal left behind thesis, I think, Phil. That's what it is. No metal left behind. Copper's coming along for the ride. It was gold. It was silver. I do like the look of copper. Pretty nice candle there. It did also kind of look like it was going to join the rest of the crew with the dollar as the underpinning denominator to that conversation. Nice eyes on the futures as always. Thank you, Phil Streible. Have a great weekend.
You too, bud.
We got to get through tomorrow trading too, but Tuesday, Wednesday, Thursday. Phil Streible, Chief Market Strategist of Blue Line Futures. All right, we got Mr. Scotty Bauer on deck. We're going to come back in about 1 minute, take this thing into the close, see if stocks can hold their own here. S&P 500 gaining a little bit of ground as we continue to see some intraday strength. We had a decent little pop there, closer to 69.50, so stocks are hanging on for the ride.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Our stocks trying to hold in here. S&P finding a little bit of a grind at 69.50, pretty much there. We've got earnings overnight. The question on the show is if a little day of some dispersion in the market might turn into broader selling. That's probably going to be up to the earnings that are coming out tonight, tomorrow, and next week. Scott Bauer, Prosper Trading Academy, joins me here with about 11 minutes into the bell. I think, Scotty, this is a day where we are getting by despite a major body blow from Microsoft, but it's kind of a mirror image market where for everything down, there's something in the same category that's up. Now make sure you're not muted for me, Scotty.
There we go.
Right.
That's better now. Sorry about that.
Yeah, hit me.
All right. who would have thought we'd see Microsoft down 11%, Meta up 11%, basically
Right.
22% spread, right? And when you look at what Microsoft accounts for in the Dow, everybody looking at the Dow just getting obliterated like the other day with, when United Healthcare was down so much. Microsoft's accounting for right now what about 350 points in the Dow. So, I don't know that I could have seen that scenario that we would have had that spread. And the market just, sure, we sold off earlier. S&P's going into the close. We're only down 20 right now. Almost like nothing is happening, right? But we still have the big guys. We've got Apple. We've got Alphabet, Google coming out next week. NVIDIA's later on. So, I would have thought that a Microsoft report like that maybe could have derailed the marketplace. And I don't think Meta is, made up for it. But again, there's a lot of resilience in this market, even though we're seeing some rotation.
Yeah, that's, I think, the core point from the top line is that we didn't break down. We held on for the ride. As much as the market didn't like Microsoft, it liked Meta almost the same amount. That math I don't know quite off the top of my head, but generally speaking, the idea, to have a big Mag 7 winner. Because the group as a whole looked like it was ready to find some technical support if I just chart up MAGS here.
I agree.
And we bounced off that the last week. So the question is, all right, were we going to kind of go back to the top of the range? That's Apple's job now, it seems like. I mean, if that bombs a very consumer-facing product, then we're not in good shape.
I agree, but for me, coming into earnings for these big guys here, it was all going to be about what was going on with CapEx. And were they going to keep it at the same levels? Were they going to increase, or were they going to start pulling back? And I thought what would have hurt is if we had seen a pullback. Yet we saw Meta came out and said they're increasing it. Microsoft came out and said they're increasing it. Obviously, there's other variables involved there, but we have that amazing divergence there. Now, of all the Mag 7, obviously Apple. I think Alphabet next week, Google is really the one to watch. And I think this thing, Oliver, is primed for another breakout. I really do.
Okay, so best way to do it. Do you go with the group, or do you go with a name, a favorite?
I mean, it's hard to go with the group just because of the divergence in some of the stocks that we're seeing. Amazon's another one. I think Amazon upside is not unlimited, but I love the upside. But I really, really like Google, Alphabet, because this area that it's approaching again right now, 339, 340, that has kind of been stuck there. Boy, if this thing gets by there, if they come out with decent numbers, great, guidance, obviously the CapEx is good. This thing could be 400. I mean, I really think there's massive upside.
I love that. I mean, hey, I feel that the companies that stand out, the most to me in the category are the ones that I see myself using the most. I feel like we are in one of those moments, where you invest in what you know and what you're seeing happen around you. And for me, that's Google, number one. It's got a great chart behind it, and it's the number one ranked AI for just the populace in terms of usage for Gemini. Chart looks good. If that earnings doesn't work out next week, then we've got major problems. I think you don't want to see that thesis break down.
No, that's the one to me from both a technical and a fundamental standpoint. That's got to be the market driver here. And I agree. If Google falters next week, that could really take the NASDAQ and the overall market down with it. I just don't see that happening.
Okay, neither do I, and I hope not. Whether it'll get a meta-style move, who knows? But I will say that it's been somewhat kind of range-bound for Alphabet, so maybe it's had enough moment to recoup there. You mentioned like Amazon too, earnings, that's a next week play. I know you're watching Qualcomm, which is a kind of a standout from the group because it's been so weak going into earnings.
Exactly. So this one is really the opposite of all the other ones. You can make a case that pretty much all the other stocks in this class, in this sector, have really held in, have had a lot of strength going into earnings. and Qualcomm is down what? It's down, basically 20+% since last earning. It's right in the middle of its channel from low to high. It's a total crapshoot. So Qualcomm to me is one that could move 10% either direction here. The bias is definitely to the downside for me, but I think it can move direction. Whereas for Google, Amazon, I really love the upsides there.
So you like being biased bullish for Alphabet, for Google, for Amazon. Qualcomm, you're just looking for a move. That's the idea. You're just looking for some action.
Yeah, I think Qualcomm sets up for if someone was just looking for that move for a short-term strangle. I'm not big into buying straddles going into earnings because you really need typically an outsized move to make any hay with that. But I think Qualcomm, from the technical standpoint here, literally can make a 10% move either direction. There is just it's a weak chart, but this thing could rebound on some really good guidance. I probably will stay away from Qualcomm and focus on the other ones, but we'll see what happens.
The vol doesn't look super duper cheap, expensive rather, for Qualcomm.
It's not.
Yeah, it kind of looks like it might. A lot of these you see super pumped up right now, especially if you go to anything
and that's why I said a strangle may not be a bad thing there. Sure, the vol's going to be going into earnings. It's going to be a lot cheaper than trading a straddle here, and I don't think that vol is juiced up yet.
Yeah, I like that. Let's do a little education here. After all, you are an academic at the Prosper Trading Academy. Here's your Google result for some strangles. Betting on a move is the point. Betting on a move, and trying not to punch too big of a hole in your wallet, spending for that volatility at the same time.
Yeah, so right here, right now at 2:58 Chicago time, market closes in 2 minutes. Right now, the market is pricing in Qualcomm for next week, roughly an $11 or $12 move. So 7-8% basically. So if you were looking for a move in either direction there, you could buy like 140 put and 165 call. Somewhere in that range there. Probably only costs you $2 or so to do that. So you're talking about $200. Maybe it's a little bit more than that, but I think it's worth the opportunity there for the potential of a big move either way.
Okay, that's fun. So you can also kind of play these against each other. I think also to kind of connect full circle back to where we started the show, talking about how correlations popped earlier in the day in the sell-off and then came back down because this market is, the mirror image market, the dispersion that we're talking about here. It does create a lot of unique opportunities to take stock-specific trades that could hedge against your index positions, or index positions that could hedge your stock-specific trades. So looking for Qualcomm volatility and spending a little bit on that, just owning premium in both directions, could be a solution to kind of hedging your short-term index exposure if you think that Qualcomm is part of the AI trade. And it's a big tech company, so I think the odds that the market goes in the direction of Qualcomm on any given day are generally pretty high.
There's no doubt about it. And there's a lot of what's called pairs trading, PAIRS, especially going into earnings where you might see vol in one spot, very, very expensive, and a similar or like stock within the sector where that vol is a lot cheaper. And so you can play one off the other. And so, looking at this, I definitely have to take a deeper look into it, but I agree with you on that vol in Qualcomm. It's not, to me, as expensive as it should be. We probably will see it increase tomorrow, Monday, going into earnings next week. But to me, that's a pretty cheap, I guess I'd call it a shot, where your risk, you know what your risk is, right? You're buying that strangle, you pay $2, your risk is $200. If the thing doesn't move, that's your risk. If you can afford it, great. If you can't, don't do it. But that's your risk. It's baked in there. So of all the stocks that I've looked at so far, that is probably one of the least expensive opportunities to do something like that.
I like that. There's the bell, looking for volatility in Qualcomm, looking for general upside in Amazon and Alphabet to support this market into earnings next week. Hey, look at this nice little grind there into the close, man. Look at that. 69, 68 for the index.
What just happened there in the last 20 minutes to gold? And this is unbelievable. I know we don't normally talk about stock specific here. I'm literally in the class here 45 minutes ago, and we put out a trade to buy a put spread in VLO.
Okay.
We were probably 30 seconds too late. We did not get filled. The thing fell out of bed.
It did.
So
despite a big day in crude.
And thinking, boy, that's one of those shoulda, coulda, wouldas.
Yeah, definite action there. Rest of the market went the other way, though. Good ramp. Semiconductors ended up on the session. Semis just continued to rock. Obviously, we talked copper, no metal left behind trade, which ended up 37 cents to 630 after a swingy early start to the session. And the loser at the back of the pack, the coins and strategy. Thought I've already beaten the horse dead on that one, but I'll give you a closing thought if you want it. Cboe.
Yeah,
Cboe Option
things.
Pro.
NOW ServiceNow. We did buy it earlier today. I love the stock. Absolutely love it. That, and I want to question you, MSTR. You had to buy it somewhere. Where would you put your bid in right now?
Well, to be honest, I kind of, I think probably I have to go back and check my TikTok on when I said, the trade is mostly squeezed, but that was probably around maybe like 180 once we went below 200. And we did end up just going sideways for a while. So at this point, I don't know, man, the fresh breakdown, it kind of makes me want to go back into that strategy of shorting strategy and being long SMH. Just my favorite way to pair core equity performance with the weakest link. But I think $100, maybe strategy, the next kind of place. You trade down to 100 and buy that dip, maybe.
Wait, and one last thing. I know we're running a little long.
Yeah, very good.
A couple months ago, Oliver, you and I had a conversation about strategy. And if there could be potentially a point that if the stock sells off so much, does that mean Michael Saylor has to start selling some of the Bitcoin?
Well, yeah, I think we're getting very close.
Exactly. I don't know.
75,000 is their break even, according to Gemini. 75,000 right now. That's not far away. That's 10K away.
Yeah. So I think that's it's some food for thought. It's not meant to scare anybody or anything, but I think it's definitely some food for thought.
Bitcoin breaks down through 80. I think it likely goes to 60. And then I think we got to watch to see what happens to strategy then, because it should reprice quick to the downside. So, but there might be hope here because Bitcoin's been able to hold the low 80s, since November. But if that box breaks, yikes.
You got it.
Look out below. Scotty Bauer, great close. Same to the market too. All right, keep getting those ramps. Thanks to Prosper Trading Academy. Scott Bauer, good stuff. Have a good one, sir. Thank you for tuning in to Chicago Future of Finance. That's it. Nice ramp into the close. I'll see you on Tuesday.